Well, good morning, everyone. I'm going to be talking about, I'm not quite sure what the right word to use is, but in a way it's the organizational problems faced by a multi-government monetary union. I'm going to be looking back to something I wrote in the early 1990s.
Sorry, can you speak up, please?
Okay, can you hear me all right at the back? Okay. I'm going to be talking about, I call it the constitutional problem, but in a sense it's the organizational problems of a multi-government monetary union. I'm going to be looking back to something I wrote in the early 1990s. You have been sent that, but I'm going to be referring to it in the sort of fourth section of my talk, which is, of course, the I told you so section. Anyway, I'm going to start off with an account of my view of the monetary determination of national income, which assumes we're not in a gold standard, we can manage the currency, and again, I've held this view for many decades now. I'm then going to translate that view into a prescription for the management of the currency in the Eurozone, in a sense, Eurozone today, but we'll look back a bit, of course. Then we'll compare prescription and practice. Of course, the ECB hasn't taken a bit of notice of what I think about the matter. But anyway, then we'll come on to I told you so. But that will actually lead into what my view about the requirements for the success of a multi-government currency union. And then I'm going to finish off with, of course, it won't be very conclusive, but and then I'm going to finish off with some analysis and some prognosis. Okay, well, first of all, this is my view about the monetary determination of national income. It isn't really very original, but it isn't nowadays very conventional either, so there we are. It's essentially that the key condition of macroeconomic equilibrium from a monetary standpoint is that the demand to hold money by agents at the prevailing level of income and wealth, prices of goods and services and assets, is equal to the quantity of money created by the banking system. That's just the basic condition in the LM curve, in Keynes, and many, many other authors. Now, I am different from I suppose, the American standard professional view in the profession, which I will just talk about in a second. I always talk about broad money. I'm not interested in narrow money at all. That implies that I expect, assuming some stability in the non-income arguments in the money demand function, may or may not be true in practice, that in fact the growth rates of broad money and nominal GDP are similar over time, certainly over the medium and long run. And when they aren't the same in the short run, that's due to monetary disequilibrium. In the long run, things iron themselves out. So that the proportionality hypothesis is basically right. And I know there's lots of discussion. I don't care. As far as I'm concerned, it's basically right. And this then implies that if policymakers want to achieve a certain inflation rate, there's an associated rate of increase of nominal GDP, then a certain rate of growth of broad money must be respected. All right? And if you don't respect that, you get into trouble. Now, that then implies, because obviously the money is the liability side of the balance sheet, certain growth rates of the credit counterparts, and that's really when we get into the prescription for policymakers. Let me just reiterate that this is my view of how this subject should be analysed and taught. It is not in any sense nowadays conventional. I reject American monetarism with its emphasis on narrow money and the view that money is a multiple of the base, and I've had lots of trouble over my career with that point of view. Anyway, that's where I stand. So let's then translate this into a prescription in terms of the rates of growth of money and credit that should hold in the Eurozone. So we can see the growth rate of broad money as a result of credit extension by the banking system, essentially to the state sector and the private sector. I'm going to ignore the international complications, important though they are. I will be talking about the role of banks' incurrence of non-deposit liabilities, non-monetary liabilities, including, of course, crucially, a banking system equity capital, particularly equity capital, but I suppose capital in general. Anyway, I'm going to take it that this would not be true, of course, in 1999, but it's true today. The trend growth rate of output in the Eurozone, I take to 1.5% a year, probably a bit higher back in 1999. It may even be falling because of adverse demographics, but it's some figure of this sort. Price stability is defined as a rate of increase in prices of under 2% a year, call it 1% a year. And then the implied rate of increase in nominal GDP is 2.5% a year, all very simple. And so we want broad money growth to be, say, let's be generous and take it that the ratio of broad money to GDP is rising, which actually is for discussion. Certainly the last decade isn't really true. But then take it that it is rising, then we can have, say, growth of broad money about 2 to 5% a year as being consistent with the ECB's inflation objective, price stability objective, and also stability, consistency with the trend growth rate of GDP. So of course, the growth of money, there's a deduction for the capital raising of the banking system. But roughly speaking, if the growth of the sum of banks' credit extension to the private sector and the state sector is equal to the stock of money, between 2 and 5% of the stock of broad money, that is the implied criterion for the management of the currency in the Eurozone to achieve the ECB's stated objectives. And so that's translating the framework into specific numbers as to what the ECB should be doing in terms of credit and broad money, which I regard as fundamental to macroeconomic analysis. I know I'm not a majority at the moment. Nevertheless, that's the way I analyze the economy and take it or leave it. Sorry, I should say one more thing before I move on. That was a bit of a jump. And I also say the growth of credit should be stable from year to year. The growth of money should be stable from year to year. I'm a free benign. And so when we look at a chart for the growth of the credit that determines the growth of money, it should be a straight line. It should be a straight line, all right? And then look what this actually was. So this is taking us back to the start of the euro, and it's fairly up to date. This is the I've added up, these are annual periods, the sums of the Eurozone banking system's credit extension to the state sector and the private sector. And in all these years, they are expressed as a percentage of the stock of M3 at the start of the year. Now, it's not a straight line. Quickly. At the start, there was concern about broad money growth. Otmar Issing was chief economist at the ECB. He then lost this debate with Woodford and others. There then was this period, 2005, 6, 7, of explosive growth of credit and money, particularly, of course, in the peripheral countries. The question of what then was the watershed between that period and what followed is for discussion. And we have the closure of the interbank market in 2007, Lehman in 2008. As far as I'm concerned, the really big change, most of the banks were concerned, was the demand that banks have much more capital relative to their balance sheets. But you can see, and I'll develop in a second, you can see that the growth rate of credit in the second half of the Eurozone's existence has been much slower. And of course, it actually went negative in 2012, 2013. Money growth was still positive, but only because of money being pulled in from abroad, human species development mechanism and so on. So what we've actually had is, the first decade, the happy period for the Eurozone, very rapid growth of bank credit in total, both the private sector and the state sector, and then this more recently, and actually a touch beneath, what I specified as being, if you like, the ideal. You may wonder how this was consistent with price stability. Well, at the start, for many countries, Spain and Italy and so on, this was a major bank liberalization of the financial sector, which grew relative to the economy. The trend growth rate was higher. And of course, there was inflation in the middle years. It was inflation of asset prices. Then if we move on, to me, the key watershed, and this is for debate and discussion, was actually, this really was a terrible shock for the banks. They had to have much more capital than before. What I want to bring out here is that banks' capital raising was in fact higher relative to assets after October 2008, even though their balance sheets were growing much more slowly. All right. This, of course, was the result of the implementation of Basel III and so on. I'm not saying, by the way, that the banks were entirely innocent, but you can see, in fact, relative to their M3 at the start of the period, they raised more capital, a little bit more, in this period when their balance sheets weren't growing very much. So, plainly, my prescription wasn't applied to the Eurozone in that period. I now want to reflect a little bit on, seems to me, what are the organizational requirements for, how am I going for time, by the way?
15 minutes.
Oh, that's fine. All right, good, okay. But for a multi-government monetary union to work, and I'm going to be using my analytical framework all the way through. All right, so plainly, it is the job of the central bank and the state sector as a whole, the central bank working with governments, and indeed in the Eurozone's case, the EU institutions, to have a range of instruments that influence the growth of bank credit to both the private sector and the state sector to achieve this sort of 3, 4, 5% growth of bank credit each year to achieve the target growth of money. And it's much more difficult in a multi-government monetary union because you've got a large number of governments and a large number of commercial banking systems, and also, in a sense, of course, still national central banks. It's also important to remember the central bank has only two types of customer, so the government and the commercial banking system. And so if it has problems in its operation, it has problems in looking after its relationships with these two types of organization. There are likely to be many more conflicts of interest in a multi-government monetary union than in a traditional monetary arrangement, traditional monetary jurisdiction with just one central bank, one government, and one private sector banking system. And these conflicts of interest simply are not found in a traditional monetary jurisdiction. When I was thinking about this subject back in the late 80s and early 90s, to me, if it's possible for Europe to have its own currency, why not the world? There's something the matter. And I'm now going to sort of suggest to you what I thought was the matter, and actually it relates very much to Hans Werner Sinn's paper yesterday. Obviously, the job of the central bank is to, in a standard monetary jurisdiction, is to make sure that the banks have got base money to settle debts, meet deposit withdrawals, See, there's the monetary policy function, and there's also the job of acting as lender of last resort for cash-short solvent banks, and to act as honest broker when things go wrong and there are some emergencies in the banking system. Can I just say, because this is something that we teach on our MSc course, it's that last function that explains why commercial banks want a central bank at all. See, Charles Goodhart's written about all this. If that weren't the case, central banks wouldn't have evolved. I mean, they might have, they serve their government, they provide finance to the government, that's wicked and so on, but it's like a benign, wonderful world, utopia, where there's no government to worry about, none of these wicked politicians. There will still be a need for the central bank to help the banking systems be efficient, to act as bank to the banking systems. Okay. These things were basically not noticed in the Maastricht Treaty. This was what led me to write my article, it appeared in the Central Banking Journal. Central banking, perhaps rather obscured, it was basically not noticed, and frankly, most people hadn't got a clue what I was talking about. There was at the time this obsession with the convergence requirements. Look, if it was just the convergence requirements, the whole world could have the same currency. There's something more fundamentally the matter with this kind of what the Eurozone is trying to do. And the difficulty is that these aspects of what a central bank is and what it does for its society via helping governments and the commercial banking system raise lots of very difficult issues. In a banking emergency, this is 1992, the central bank has to respond flexibly, pragmatically, and with full discretion. There is often a large element of rough justice. I was a shareholder in Northern Rock. And then this was a conjecture I made. A refusal by the ECB on the grounds of monetary discipline to act as lender of resort to a particular bank in a crisis, a particular bank in a particular country, would therefore severely damage the one country's banking system. Therefore, in practice, lender of last resort facilities are likely to be given quite liberally. Okay? And that, of course, is what's happened, although, as we'll see, of course, there's a resistance to this. And then there's this problem that the central bank has some assets. It could have entirely foreign exchange, but that raises issues too. But suppose it's going to have claims on the state sectors in different countries. Yes, the Bundesbank prohibition on overdraft lending to governments was replicated in the Maastricht Treaty, but it's still possible for the central bank, the Euro system, the different central banks, to purchase government securities in the secondary market. And that implicitly there is then going to be consequences from that for national governments and for the management of national debt, and then for particular nations' fiscal policy. And I made this comment back in 1992. There is no objection to the ECB buying government debt in the secondary market. The ECB directives have come under strong pressure to accommodate such indirect government borrowing, and all sorts of plausible arguments, other kinds of persuasion, would be used by governments to gain access to such finance. Further, extremely awkward questions relate to the ECB's holdings of different governments' debts. Let me then bring all this together. I told you so. Look, this sort of thing should work relatively easily if the assets of the banking system, the whole banking system, are claims on the private sector. They're growing very stably and beautifully through time, and these assets are being acquired by profitable, well-capitalized banks that never need to borrow from the central bank. Okay? In that sort of world, the Eurozone is going to be a success. As soon as that comes to an end for whatever reason, and there's going to be last resort lending from the central bank to the commercial banking system, and there's also going to be implicitly government finance to particular governments, maybe through purchases of securities in the secondary market, oh no, there's going to be lots of tension, lots of trouble, lots of squabbles, and so on. So Friedman said that the single currency will work fine until the first crisis. So what happened in the first 10 years or so of the Eurozone was that everything was fine in the sense that the credit extension was very much lending to the private sector. And there wasn't at that time much worries about the banking systems of Spain, Ireland, and so on. In fact, the share prices of Spanish and Irish banks just soared in the first decade or so of the single European currency. All right. And then you look at the second half of the Eurozone's existence, and you can see that the credit extension of the private sector has collapsed. There has still been growth of money and credit, but there's been a much higher portion of credit to the state sector. And of course, in 2012, 2013, the money growth depended on bringing in money balance to the rest of the world through a balanced payment surplus and so on. So just in terms of figures, this is a dramatic contrast between those periods. The first period of when everything's going fine, and then the second period when there's trouble. Now, what I'm about to say is all pretty much nothing very startling. As I've already said, a lot of the lending to governments in fact arises from purchases of government securities. That is in fact in the data recorded as credit to government, even if it's not overdraft finance. The first really controversial episode was back in May 2010, when the ECB made large purchases of Greek, Irish, and Portuguese government debt, and later Italian, Spanish government debt. At any rate, it's certainly very controversial. And then, of course, we've had these various sort of ancillary institutions that have been set up to, in a sense, paper over the cracks. But there we are. It's again, there's been, and then we come to. Can the problems have been so far with relatively small countries? What happens if they're big countries? And Chancellor Merkel's, this is really in a sense what it's all about. There will be no collectivization of debt in the European Union as long as I live. All right, there it is very clear. Now, there's obviously tensions in this system. Can I just say, I did tell a few MPs about this kind of stuff back in 1991, 1992, and they're still friends, and they're the Maastricht rebels. So they're a part of the British Eurosceptic. The problem with the when the crisis started, I take it it's August 2007, not Lehman, but we could discuss this. The ECB was indeed very helpful to commercial banks in the Eurozone in a way that, for example, the Bank of England wasn't, at least not initially. And so you had the non-standard measures, you had the moving away of the target 2 balances starting to move away. And then it must have been late 2009, Jürgen Stark, representing the Bundesbank point of view, essentially persuaded Trichet and the Governing Council that they had to cut back on these standard measures. And so the Italian, Greek, Portuguese banking systems realized they're going to lose funding, and the Greek banking system sold off the government debt, and the yield on Greek government debt went up to the 20s and 30s, and then you had May 2010, the purchases of Greek and other government debt by the ECB after the difficult weekend with Merkel being bullied by 3 Frenchmen. Anyway, so there's this battle going on all the time, and the target 2 settlement system is the symptom of it. All right. think after the presentation yesterday, I think I to repeat all this again. There is one point I want to make here, and this is in a way, again, the fundamental point. This is really, in a sense, the issue that's behind this conference. There's clearly a huge resource transfer implicit in this diagram. Basically, with the current level of interest rates, it would be different if there were high ECBs charging high nominal interest rates, but it isn't. There's basically no return. That Germany is receiving no return on about €1 trillion worth of foreign assets, and there is implicitly, therefore, a massive resource transfer from Germany and the other creditor countries to the borrowing countries, the countries that have got some debts. This all goes back to those problems that weren't actually talked about in Maastricht, as Hans-Werner, you said yesterday. They weren't looked at in Maastricht at all. But they were implicit in the fact that, in fact, the central bank had to be lender of last resort, and it had, it was banking the government. All those banking systems, all those governments. I think most Germans are perfectly happy with this and don't understand it. And that's what came out in the presentations we've just heard earlier this morning. Although, in fact, clearly Germany is much worse off because of this and the other creditors, most Germans don't care. They're prosperous, they're stable, the rest, they don't really care. But at some point, this has to stop. And not only I would say it has to stop, but somehow those lines need to come back down again. Otherwise, over potentially decades, there is just a huge resource transfer going on from the creditors to debtors. I mean, and the way I point this is that if Germany instead had made equity investments, around the world, yielding like the American investment 10% a year plus, like the American FANGs, that's what Germany has lost by blessing this enterprise. Debate and discuss. How many minutes? 2 minutes. Okay, I'm coming to the end. Okay. Now, just a prognosis. So that's what I just said, and the whole issue is very complex and opaque, but this all goes back to what was being done in the early 1990s, setting up the single currency. I just talked about the withdrawal of the non-standard measures, the first attempt to do this, which then led to the sovereign debt crisis, the doom loop, and all the rest of it. Are we going to get into the same thing in 2019? You see, I mean, I read the announcements different ways, but to me, QE in late 2014, early 2015, rescued the Eurozone. What Draghi has done, both with the LTROs at the end of 2011 and QE in 2015, was indeed very crafty. He actually kept the Eurozone in being by these two steps of measures, which were both in defiance of Bundesbank orthodoxy, effectively. And both of which benefited Italy differentially. And of course, there's now, the Bundesbank tradition in the ECB. They want to stop these LTROs and stop QE. They want to get back to Bundesbank orthodoxy. Well, I got this wrong last year in a sense. I actually advocated Eurozone QE all through the 2011, 12, 13, 14 period if they wanted to rescue the thing. It then did lead to faster money growth. There did lead to macroeconomic recovery. And then I said, start of last year, when it clearly was the asset pledge being phased out, and there still is this attack on, and it's understandable, a regulatory attack on the Italian banks. You're going to get slower money growth in 2018. I'd expect a slowdown in the economy. Potentially, they're going to get back to. They're going to get back to these kind of growth rates of broad money. When that's only positive because they're dragging money from the rest of the world. Recession, unemployment, euro loses popularity. Well, I don't know. So that's just to reiterate that the ECB should be managing credit to achieve positive money growth at a low rate 3, 4, 5% a year. And, you know, actually when it's been doing that, things have basically been all right. But then you get this problem of the resentment by German and, if you like, Northern Europe countries in general about club-led irresponsibility. I mean, sorry if it seems a rather offensive phrase, but there we are. So, just to finish it off, you know, the line that monetary union can only succeed in the long run with political union is not very original, but I would say, you know, that we've emerged is that the centralization of fiscal and debt management powers is an important part of making a monetary union work. And similarly, the centralization of banking supervision and resolution powers, provision of lender of last resort finance and deposit insurance arrangements. All these things were ignored in Maastricht. You know, I spent much of the mid-1990s saying, I don't think this is going to, you know, the euro can't happen because they haven't sorted these things out. People thought I was mad. Well, there we are. So at the moment, the problem we've got is that Germany, the nation's largest and strongest Eurozone economy, is plainly opposed to mutualization of banking risk and public debt liability. That is the situation, despite the last paper. And then I'm going to sort of, in a sense, surrender. Look, I couldn't help, but I've basically been a cynic and a skeptic about this process from the start. Look, the euro has succeeded. We're 20 years on. It's popular. So, the legal nightmare of leaving this thing. When push came to shove, the Greeks decided to stay in. You can get, and you know, it's true, there are now, you look at these public opinion, and there are countries that where public opinion, they want to leave the European Union, but they want to keep the euro as their currency. And then just finally, so that's just what I just said, and there has been a lot of extending and pretending, and God knows how long this would carry on, but to me, the thing that would really change the situation in 2019 would actually be an easing of the Basel III capital rules. I'm underwhelmed by the, I never have been persuaded that there was a strong argument to move from Basel II to Basel III, and in my view, that was what really caused the intensification of the Great Recession from late 2008. In my view, also what's going on at the moment is that actually Jay Powell, Donald Trump and co are basically making sure America is escaping from Basel III. And what you're going to see in 2019 and 2020 is the American banking system growing quite strongly, when Europe has all these problems. Actually, an easing of those rules would make things make life easy for the Eurozone again for 2 or 3 years, maybe longer. Thank you.